Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast. I'm your host, Christian Allen, and with me, my trusty co-host, Rod the Pod Zabriskie. Rod, what's up, man?
Hey, I am doing great.
How do you feel about being called trusty? I wasn't going to call you my sidekick. No, sir. Co-host, but still trusty. That's okay, right?
Trusty, yeah. I'll take trusty.
Okay.
Yeah.
Okay. Yeah. All right. Sounds good. Hey, Rod. So the last few weeks we've been doing our alternative investment series, and I'm just skipping small talk. We're going right into it. We're just going
all right.
Right
okay. Serious.
So no
serious
updates
business
on Rod's life today. We'll wait till next week to get a. Here's the thing: if we do it every week, Rod, we won't have nearly as many like big events. So we'll circle back here in another
suspense too. Yeah, I see what you're doing.
Okay, so the last few weeks we've been doing our alternative investment series. 2 weeks ago, we talked about, or part one, I should say, we talked about why alternative investments matter today as much as they ever have. In part two, we broke down how to actually build our individual investment strategy. In part three, Rod, we are going to talk about how to spot a bad investment. And can I just tell you, it seems as timely now as ever.
Yep.
Wouldn't you say?
It is.
So it just
unfortunately
seems like a good time to have this conversation. Like,
yeah.
Look, a lot of us have been through like these kind of difficult situations, and many of us in our communities have experienced a lot of good in the alternative investment, and unfortunately, we've also experienced some of the bad. So it just feels like the right time if we're going to be talking about why alternative investments are such a powerful thing. We've got to make sure that we cover the entire spectrum. So today we're going to focus on what we can do to kind of try to spot a bad investment and keep ourselves away from as many of the difficult bad situations that can come up as possible, because we have to acknowledge that the alternative investment space is still a little bit of the wild west, which means that the responsibility lies on us as investors to do more due diligence, to be more thoughtful. And again, that's part of why a lot of these investments are for accredited investors, right? We're willfully going to take on that risk for the extra returns, for the bigger upside and opportunity, but we have to be smarter with it. So what are your thoughts, Rod?
Yeah, I mean, I totally agree. And what's cool is that you live through these cycles, you see certain things happening. And I think what it does for us is it makes us smarter, and we're not going to pretend like we have all the answers or that we're going to try to cover everything today, but we'll kind of talk through some of the things that we've learned, because what we know is going to happen is the cycle is going to swing back to where things are going really well. And we need to remember what we learned in the most recent cycle, because it is cyclical.
History repeats itself.
It does. Yeah. And it's not going to be the same every time, but if we can establish a process, a way of approaching the way that we invest, so that we are always keeping in mind, not getting overly enamored by certain things that come up, and we'll kind of talk about some of those red flags. We stay disciplined, then we're more likely, it's not like we're going to avoid all, negative situations, but we're more likely to see it coming and avoid it because we move on. We just pass by it.
So we have to establish principles, right?
Yep.
Principles that we're using, or principles and a process that we can use to kind of vet our deals. And admittedly, like it's going to be situational. Like I always go back to situation's the boss. Sometimes it might take somebody else supporting us to create the level of due diligence that we need. Sometimes we might have the level of expertise or specialization to be able to do that. But one of the things I will caution is, just as a starting point, don't try to be an expert in everything, right? If you're an alternative investor and you're looking for deals in many different spaces, you might and likely will need support to vet deals depending on the industry, right? If you're a multifamily syndicator and yet you want to go and do some things outside of that, maybe in a traditional business world, well, you might want somebody who like really lives in that space to be good. Okay, we'll get into that, Rod. But I want to talk about some of the things that I just think are important to remember as we're having this conversation. So the first thing is this: we have to pay attention to more than just the return, right? When we're trying to figure out what a bad deal looks like for us, it has to be about more than the return. So things to consider are things like our own values, right? How does it align with our values? How does it align with our risk profile? Is there like the structure, the transparency, all of those kind of core things as a starting point? It can't just be about the return. And I think everybody knows that, right? Like that's just kind of a given. And yet it's easy for us, and I'm no different, to get enamored by strong returns, especially when a lot of people around us are participating and going in on those same types of deals.
Mm-hmm. Right. And when you go back to some of the core principles that we always talk about in the invest with benefits kind of framework, we're telling people look for more than just the return. What are the potential tax benefits you can get from it? What kind of cash flow can you get from it, in addition to the potential for appreciation and growth and that kind of thing? So, and then we talk about velocity, where it's important to keep your money moving, get into the next deal, and things like that. And so what we want to do is, that's why I used the word disciplined earlier, is because we want all of these things, and we may be pitched something that looks like it fulfills all of these things, and we have to be just, well, again, disciplined in the way we do our due diligence to make sure that we don't just get the shiny object syndrome and we're just tasting all these things just because they're shiny, but we're not doing what we need to do on the front end to really vet it.
Okay, another thought that comes to mind, Rod, maybe there's more, but at least in my mind right this second, there's two types of bad deals, right? There's a totally legitimate investment opportunity that goes bad for one reason or another, or several reasons, right? Maybe it's market conditions and factors. Maybe it's even a lack of execution in some way by the operators. It could be a variety of different things, but it could, and absolutely, we see this all where it's a potentially good deal. It's totally legitimate, but it just doesn't go that well, right? Maybe we lose some of our money. Maybe we don't get the kind of return that we hoped going in or whatever, but that's obviously a legitimate situation. And then on the other side of it, we have the bad deal that's just a scam. And unfortunately, these are more prominent than any of us tend to think, right? Like they just are. We've seen them all over the place. Even in the last decade, it's one of those things where, like, when the market's doing well, it seems like even like the scams can do well. And then when the market turns, it's like some of those things, like that's when they're uncovered. And it becomes really difficult to understand which is which. And so we have to be really thoughtful and careful and try to figure out on the front end how to parse those things out. So one of the things that comes to my mind is realizing that, like, when we talk about track record, for example, track record's got to be longer than, a few months or a couple years, at least if you're talking about. Now, I get it that people have to get a start at some point. And so my advice to someone that wants to get a start is work with people who do have the experience so you can build the experience. Yeah. So, like, there's a way to layer that. But what I'm not doing is I'm not going, most likely, unless it's like a small sliver of my capital that I know I'm being ultra aggressive with, I'm going to make sure that I'm going to be working with people who have a longer track record. Well, longer to me doesn't, again, mean a year or two or three even. It probably means 10 years, 15, 20 years, right? Someone who's been in the space, working that, really understand, that's been doing it for a long time and having success, showing a track record of producing returns for investors. That's the kind of thing I'm looking for. And I'm looking for that more today than now. And now, after lessons learned, than I ever have before. Because again, I look at this last cycle And we were fortunate. Like, we didn't have many deals that went bad, but we did have a little bit of stuff that struggled, right?
Yep.
And one of the things that stood out in my mind is that I looked at track record as something much longer than it actually was, right? I looked at a few years and felt like, oh, okay, investors have been getting returns on this for the last few years. Looks like we're in a pretty strong position. Well, in our case, it ended up being that we were at the back end of what ended up being a scam. And so we didn't get much back. You know what I mean? Like, we didn't even get the payments for the few years when it was doing well. So, like, again, these are lessons learned that we're hoping that we can be really open and kind of transparent about, in hopes that everybody listening will, again, just learn lessons from their own experiences, and from some of the good things we've done, and from some of the mistakes we've made along the way. Okay, so do you have any other thoughts as it relates to just kind of this? I kind of went on a tangent there about the two types of bad deals: legit deals that go poorly, and just scams altogether. Any other thoughts that I missed out on there, Rod?
Just I haven't seen a lot of these scams, but in the few that I have seen, or have enough intimate information about to make any judgment call, it often seems that they started legit, and then something happened along the way that pushed them over the edge, made them
That's a fair point.
Like, start to exploit. They weren't exploiting from the beginning.
That's a fair
something
point.
pushed them to do that.
Yeah, I think that's a really good point. Typically, it's like the pressure, or a lot of times it comes up when we did the American Greed episode, right? Some of this kind of came up. A lot of times it starts out with good intentions, something goes wrong, but then whoever's leading it feels the pressure to get, like, they'd rather take, like, I don't know, take a short-term shortcut, I guess, and make the assumption that they can make it up and get back on track. And then before they know it, they're spiraling the other direction, and there's no way out. And it became something that was like maybe a tough situation into a massive situation. And so I think that's a good point. And maybe the point there is that we have to be thoughtful and watching our investments even after we've made the investment. You know what I mean? And be kind of thinking about those elements, because in a lot of these situations, if that's the case, it's really difficult to spot that as a bad deal if they start out with the right intentions, especially if they're people who have started out with a track record of success and other things, right? So anyway, I think that your point's right on. It also just kind of makes it hard. Okay. So I guess what I would say to do is just take the time, make sure that you're not in a rush, do the due diligence, and most often those things will come out. The other thing that comes to my mind is don't rely on other people to do all of your due diligence, right? I talked about how you might need other people to support you. That doesn't mean that you want other people to do it entirely for you. So I think one of the things that happens, especially today, like, we're in these investor communities, a handful of people, make a decision to go and invest, and basically everybody else kind of follows on their track record, or they feel like, hey, so-and-so is a smart investor and they're doing this, so therefore I'm going to do it. Or so-and-so is saying to do this, and, they have they have all of this credibility, therefore I'm going to do it. And that, again, I think probably pushes as many people down that direction. Like, that probably pushes more people down the direction than anything else, right? So, like, maybe I just think about, I am absolutely guilty of this in the more recent market cycle, not getting enough into it just because I felt like it had been there for long enough, and enough people that I knew and trusted were part of it. So I just kind of figured, okay, I don't need to do that same level of due diligence. And I'm somebody who's like an active investor, right? I'm somebody who's teaching people to invest. So, like, these kind of mistakes can happen to anybody. Again, our hope is that we'll kind of explore what those are so that they don't happen to us again in the future, right?
Yeah, and maybe by extension, we have to start somewhere, right? So we do our on the front end, we do our own due diligence and we feel like we're doing a really good job. And then the next opportunity comes along and we feel like maybe we're overconfident in what we know, or because of the success that we had in that category. Again, let's just say multifamily, because this is the maybe the biggest glaring example recently. Is I did the due diligence, I felt good, I invested in a certain group, they have another deal coming up, I'm good. I don't need to spend any time because I
I don't
already
need to do
know
the
what it
same thing
is.
again for each separate deal, right?
Yeah. And there are two challenges to that. Number one, each project or each fund or whatever it is going to be unique. And then secondly, the if I am only ever doing that, I'm only ever going back to the places I've dealt in before, then I'm not diversifying myself across, even if I'm still sticking with multifamily, but I'm doing everything with the same provider and on the same model, on the same schedule, whatever. If that schedule breaks, all of my deals go with it. Right.
Yeah, so you're
So
just saying you need to be more diversified. And again, a lot of people probably learned this because they did exactly a lot of people have done exactly what you're saying. They get
yeah.
locked in with some people that they felt good about originally, or that the community feels good about, and therefore we're just kind of going all in on that. And I think that is a huge lesson learned for a lot of people.
And it's so hard because we're busy people, easy to just rely on what we've done in the past. And again, I'll use again, discipline. We have to be disciplined to continue to do high levels of due diligence and diversify.
Yeah, and I will say this though, the nice thing is that the upside is so much more, like so much better than if I were to do the exact same or put the exact same effort level in when I'm talking about my mutual funds. Because at some level we have to be looking at the investments and be thoughtful about them regardless. If I'm more thoughtful about my mutual fund investments, I can have a little bit of an impact. But if I'm more thoughtful about my alternative investments, I can have a massive impact, right? A generational wealth level impact, not just, a little, extra income in retirement that I wouldn't have had otherwise. Like we're talking about things that really, anyway, we get into that. Okay. So we talked about kind of some things just to be thinking about. Rod, I want to next go into red flags to watch for. Where should we start when it comes to red flags?
Yeah, I mean, we're going to hit on a list of different things, but let's start with lack of transparency.
Ooh, that's a big one. Seems like a good starting point, because if that's not there, or if you don't think it's there, or even there's hints of it, that's worth running to the hills for immediately. Massive red flag. I just think that's non-negotiable.
Right. And maybe kind of in conjunction with that is knowing who's actually at the controls, right? Because
That's
as we
part of
know,
transparency.
yep, as we know, there are people who are money raisers, but they're not actually at the controls of the investment. And
That's a good point.
I'm not saying that's a good or bad thing. In some ways, it can be really valuable. But if I don't know, if there's not the level of transparency where they're saying, "Hey, I'm not the deal. Here's the deal. Here are the people. Here's the access to the information that you need to make a good decision," then I'm not seeing what I need to see in order to make the decision, right?
Yep, I think that's a huge issue. Huge issue. So whenever you're going into it, just any sort of transparency flag or hint of lack of transparency that comes up is just a massive red flag. Can't say it enough. And to your point, it's really difficult when we don't know who's really making the investment decisions. And I think a lot of people that we know have been, I'm not going to say guilty of this, that's not the right word, but have maybe not realized the extent to which other people, like, again, who's at the controls, who's making the decisions. And so they make the judgment to be in an investment based on a different set of criteria than what's actually happening. And that's your point. We want to get deep enough on the front end to know what's going on so that we can make those decisions. To some extent, I mean, unless it's like being hidden from us, like it is on us as well to make sure we know those types of core things when we're going into investments, right?
Yeah, and
Now, I think capital raisers in general should absolutely be on the front end of transparency and just be proactive about it. But that doesn't take that responsibility away from us as investors either.
yeah, for sure. Because when I'm going to come with my list of questions that I need information, I need answers on, if I'm asking, I need to be asking the person who actually put the deal together, is going to run the deal, has the answers to those questions. Because if I'm asking the middleman, they may or may not have those answers, but they may just pretend or approach it like they do, right? They feel like, oh, I'm knowledgeable about this. I'll answer your questions. But they're not gonna have the same depth of knowledge as if I'm actually talking to the person who put it together and is actually going to run the deal.
Yep. Good point. Where do you want to go next, Rob?
So next is, we hit on this a little bit earlier, is an unverified and unaudited track record.
Yeah, well, we talked about track record, but now
Yeah.
we're talking about like basically a potentially misrepresented track record, right? People who are inflating their track record, suggesting that it is something that it is not. Or again, like it's easy to go out and say, hey, this is what our deals have done over the last however long and promote that. But there should be another level of being able to prove that out so that it's not just, hey, our website says we've always got 21% on all of our last 18 deals. Like, hey, that's great, but let's get into it and understand it, right? There's a difference between what people are claiming and what's been verified.
Yeah. And so now again, this goes back to transparency, because you need to be able to find ways to verify.
Yeah, great point.
If the only person you're able to ask is the provider, they have a bias in, coming to the table. Again, not to say that the bias makes them a bad person or that makes that they will misrepresent. They may be
just want to be aware.
Perfectly. Yeah, they may be right on in every detail of what they're saying about their track record. But if I can get to investors or other groups that they've worked with to verify or get some level of verification on that, then I'm going to be in a much better place.
All right. So you're just saying you would suggest getting third-party verification of investment deals, not just relying exclusively on the investment provider to suggest their track record. Okay. I think that's good advice. Rod, one of my least favorite things, and this will get me running for the hills as fast as anything that's high pressure or like really deadline driven. I've never been a fan of that. I hate the idea that we're trying to get people by using scarcity, like you're going to miss out on the opportunity. Like I get that deals genuinely do have timelines.
Yeah.
But I think there's a difference between like creating that scarcity mentality and suggesting like, hey, we don't know when the next deal is going to come. Like this is the best thing you're going to, like those kind of things that are more, but again, that they're higher pressure and make you feel like, if I don't get into it, I'm just having all this FOMO. Like to me, a really good investment group is going to continuously put out great opportunities. And, there could be situations where they might suggest like, hey, this is a one-time offering. We're not going to be doing this again. But then to me, there's no reason that they have to take the next step, right? People have to take the next step and try to like make you feel like you have to get in right now. It's now or never type of stuff. Because again, that's, what we typically see is that's when people make those emotional decisions and they oftentimes look back regretting it or getting hurt because of it.
Yeah. And I totally agree that you have to be willing to let some of those things go past because especially if you're just late enough learning about it to where they're bumping up against that deadline and you can't dedicate your time between now and whenever that deadline's coming to do the due diligence, then you just have to let it go.
Yeah, that's a really good point, right? So maybe that's just like a lesson learned. Like make sure that FOMO is not the reason that you're investing, right?
Yeah.
Because despite the fact that we would rather work with only investment providers that avoid that tactic, let's face it, a lot of them are using that, hey, you've got to get in by this deadline. And again, that doesn't mean that there's not any legitimacy around having deadlines. There genuinely
Right.
are those things that exist. But I think we kind of inherently know when we're reading those emails that come out about deals, like we kind of know, right? Like, and I say that maybe everyone doesn't know, but like when I read those, I can typically feel like, okay, this is what they're trying to do here. And similarly, groups that I probably view more favorably do it a little bit differently, right? There
Mhm.
is kind of a different vibe and feel from those. Okay, so high pressure tactics, deadlines, avoid that like crazy. Over promising guaranteed returns, or just maybe not talking about or making people aware of the downside risk. So
Yeah.
guaranteed, like that's obviously an issue. There's just not very
Mhm.
many things that are guaranteed. So we live in this really fortunate place as life insurance experts where we actually do get to use guarantees as it relates to like whole life insurance. They're whole life guarantees, right?
Mhm.
But like in the alternative investment space, you just should throw it out the window. There's like no such thing, right?
Yeah.
And even if the guarantees, like if they're guarantees, they're ultimately going to be based on the backing of that company. And
Mhm.
so, when we talk about guarantees, we're talking about, billion-dollar life insurance companies that have been around for 200 years and are guaranteeing like a 3 or 4% return. Like we're
Yeah.
not talking about them guaranteeing 10 or 12 or these, But I look
Mhm.
back on, I've told this story before. My mom was the victim of an investment scam, and it was a REIT that was in the form of a note, and and it literally said 12% guaranteed on her
Oh, wow.
little, and this is this was back in late 90, or I guess early 2000s. Sorry, it was back in the early
Mhm.
2000s. So like people were drawing those kind of returns pretty easily. And it was funny, to your point before, while we're talking about lessons that we learned, I look back on that one, and I think it did start out legitimate as well. Like there was initially apartment buildings that were purchased, and over time it just ended up, getting further
Hmm.
away from that, to the point where they started offering things that weren't collateralized. It was a note. Well, notes don't go very far when investments go belly up, right? That's
Yep.
why my
Right.
mom lost everything from it.
Yeah.
So anyway, my point was on that one, just if people are talking about guarantees, then I would just kind of walk away from that immediately, just because it's too hard to make those guarantees, uh, and most people aren't going to have the track record or financial backing to be able to do something like that.
Yeah. And then the other kind of part of what you talked about with if they're speaking of it as if there's no downside or there's no
Mhm.
risk, it's risk free or whatever. That's the way that's coming across, then that's a huge
That
red
acts
flag.
as though it's a guarantee, right?
Right.
Now, it's not
Right.
necessarily saying it's a guarantee of this outcome, of like a specific return outcome, but it is saying it's a guarantee. We're basically guaranteeing that it won't lose, right?
Hmm.
And that, even that, I think is hugely problematic. And I say I think, well, the SEC thinks so too. So
Yeah.
like the reality is that's not something that the alternative investment space can legally even do. So just avoid guarantees altogether. And
Yeah.
anyway, what were we
And
going to say?
and there are always risks, right? There's nothing that's risk free. So if they're not owning that up front and being forthright about, okay, well, so here are the risks, and or when you're asking questions and they always are diverting away from any talk of risks, that's a huge red flag. Either they don't know that they exist, or they're just not willing to talk about them because they're afraid that people will decide not to invest if they talk about it. Well, that's a big, huge problem.
It's a massive problem. Massive problem, Rod. Okay, this next one really gets to me, Rod. This one really gets to me. So, if anyone remembers, again, going back to the American Greed episode,
Hmm.
these are some of them that commonly came up when we're talking about scams. But specifically, that we're calling it emotional trust marketing. What does that
Yeah.
mean? It means that we're using some sort of influence, like faith is a big one. It could be the community that you're a part of. It could be race, right? We saw that one be a big one. And those kinds of things where they're really drawing on not the acumen of the investment or the acumen of the investor, like the promoter of it. They're drawing on people's literal emotions, the way that they feel so strongly about certain things. That's what's driving people toward it. And I'm not going to suggest that that always is like that's always a scam. I just think it's a red flag of a scam, right? It is one of those things that if that's happening, I would immediately take a second or third look. I'm not saying that there aren't good people who do things that are like, I see people who focus on faith a lot in different ways, like out in the LinkedIn community. I'm not saying that there's no place for talking about faith, but what I am suggesting is that if that's the impetus for investing, then it's hugely problematic.
And that is often combined with the one we talked about earlier with high pressure tactics, because the assumption, again, if it's a bad actor in that case, they're relying on this link that you have, again, whether it be faith or race or family, friend, whatever, they're relying on that being the basis of your decision. And so if you start asking questions, then they just be turned into this kind of high pressure, like, well, look, you just got to make a decision. Here's your deadline. Here's, whatever. And they're not actually answering your questions. Then double red flag, right? But
double red flag indeed. Okay, Rod, this next one, fuzzy entity. I can't read. Let me try that again. This next one, Rod, is fuzzy entity or ownership structures. When we say that, what are we talking about?
People get creative, and rightfully so, right? So the way the tax code is written, the way that tax law works, all those things pushes us into places where we do, I'm going to set up an LLC. Like my own state's LLC isn't good enough, so I'm going to go and set it up in Nevada or Wyoming or something else. And so we're not saying that all of that structure is bad or there's no purpose behind it, because there certainly is. What we're saying is if you're getting into an investment deal and there's layer upon layer between you as the investor and the actual ownership of the property or where the asset is, that can be indicative of just issues like, what are all the reasons why you're doing that? And I mean, if they can come up with clear answers on that, then it's no longer fuzzy, right? But if they're moving away from that, hiding things, lack of transparency in that, then you have to start wondering what's going on.
So the thought that comes to my mind is that if it looks atypical within the industry standard, then that's an immediate red flag. Well, the problem with that is that I have to have a baseline in order to understand what's fuzzy and what's not, right? So the starting point is I've got to know what the entity and structural ownership should look like in the type of investment that I'm considering, which again might require me to use my attorney or my CPA to understand that. But I think like that would be kind of a standard to kind of put it against. If it's not meeting up to that typical standard, then you've got to know why, and you probably are going to need to do additional due diligence. And if you don't know what the standard is, then you just have to do the due diligence either way.
And or be willing to walk away from that deal to give you time to get more familiar with it before you'd be willing to do it on the next go around, right?
Absolutely. That's another option. Okay. This is a big one that we see, especially in the marketing material. And I think it is potentially a red flag to watch for, but I also don't want to put too much emphasis on this. And that is that the sponsor has no skin in the game. I do think it makes more sense for sponsors to have, skin inside of their own deals in some way, shape, or form. I feel like it's an absolute prerequisite necessary for a good investment deal, just because, just like anybody, they may find a really great deal and not be sitting on the capital that they would have otherwise been sitting on, and therefore need to raise the capital. So like there's situations where it could make sense for someone to not have it. And yet I would say typically it's just a good idea to know that they have skin in the game. They believe in it to the extent that they're willing to put their own money on the line.
And often the reason why they wouldn't is if they're so early in the game, they're like, well, I can't do the deal unless I raise the capital, right? I don't have any of my own money to put into it. I have to use other people's money to do it. And then obviously that then exposes or brings up other issues if they don't have the track record. Well, okay, now we're going back to what we talked about previously. But to your point, there can be some legit reasons why an experienced group with a strong track record doesn't always have liquid capital when the deals come up. So maybe there are times, but
more often than not, it's like it's probably a good thing to, like, again, a red flag. That's why we put it here. It is a red flag if they don't have skin in the game, but I wouldn't call it, the end all be all. Okay, so I think the core message that we want to emphasize is that most of the bad deals will show signs, and this isn't like a victim blaming game, because sometimes people and organizations can be incredibly deceptive, and they can be incredibly sophisticated in the way that they're being deceptive, and there's not a lot that we can do about it as investors. Like, that's part of what we sign up for when we decide to invest in this space, right? We have the much greater upside, but we also have to rely on ourselves to kind of, know and understand that and take on that risk. But again, if we're looking for those signs, I feel like even today, like, even though we've been through a lot of good, a little bit of bad, and the message I give to myself is the same thing. It's most things show signs. If we just do the due diligence on the front end, we'll likely find out. We'll likely find those things. And and then honestly, my take is that even in those situations where there's just no way for us to know, the upside and the additional opportunity I get from investing in the alternative space is so much greater than what I view as the potential mistakes that could happen along the way, that it still feels like a no-brainer. But anyway, that's kind of maybe the key messages that I'm taking away from this, Rod. What's your thoughts?
Yeah, I mean, I think one thing that we've talked around and hit on some is that we're really vetting the people as much or more so than the actual deal. Numbers on the paper tell a story. It's a story that I need to know about a specific property or whatever fund. But the operators, the people who are backing it up, that's much more important and critical, that I have confidence in those people, in their experience, their know-how, etc. Just the fact that I think they're good people can't be enough. They have to be competent in what they're doing, and I have to have that confidence.
Yeah, I think there's a balancing act, right? Like, it can't be overly influenced by one side or the other. I think if we have really great numbers, the deal looks awesome, but it's a sketchy operator, then it's a no deal, right? If it's a really great operator, but the numbers look sketchy, then it's still probably a no deal, right? So those two things have to come together to the point where we feel like the numbers look good, I'm comfortable with what's happening on the project side, and I've done the diligence on the actual operators to know that I'm in a place where I know, like, and trust them to the point where I'm willing to actually hand over money with the expectation that they're going to create something of value for me, right?
Yep.
So, but you're absolutely right. It can't just be about the project itself. So those two things, like, I don't know if we weigh them evenly, but both of them have to be in alignment in order for it to make sense.
Agreed.
Okay, Rod, the last thing I want to talk about before we call it for today is just maybe some of the ways that we look at the way that we evaluate deals. We've been in this game for quite a while now. I've been doing this for 20 years. So I've seen, I was right here for the 2008 craziness. That if you were in the alternative space, like going up to 2008, you just absolutely crushed it, right? Most people did. And then 2008, man, it got a little bit more difficult, right? Or for some people, it got a lot more difficult. And then we saw this incredible run, just a few years later that lasted almost, like a good decade. So I guess, what are some of the things that you've learned over those last 20 years, and maybe advice you would give to people about things you're doing today that they should probably consider doing as well?
Yeah. So one of the things in any deal, I have to know how it fits inside of my risk profile and my goals. And we touched on this in the previous 2 episodes, right? If I'm investing in the alternative space, I need a plan. I need to stick to the plan. It's not that I can't adjust it when necessary, but okay, then adjust the plan, right? And stick to the plan. And so when evaluating deals, I'm identifying how is this deal fitting inside of my plan and doing the due diligence to know that what I'm thinking is actual reality as it relates to what the deal is offering, right?
Yeah.
So, and always as part of that, I have to think to myself, okay, well, what if the results are delayed, right? They're saying it's a 3 to 5 year turnaround. What if it was more like 7 to 10 years? Am I still interested? Am I willing to put the money up if it's going to take longer to get it back? What if the return is half of what they're saying, right? Am I still okay with that? And again, putting my money into that. Now, the one thing that I want to
be excited about that, Rod, but that
sure, that's not what I want.
Right, but could I live with that outcome without it, having some dramatically negative impact on my financial world?
Yes. And some of you might hear me say that and say, well, then all the deals are out, right?
Right.
Because I wouldn't be okay with that. And so I think you bring up a really good point, because the upside opportunity exists. So fact is, it could turn around in a shorter time frame, and I could earn higher than the what they're showing right in the prospectus. And so I'm not making decisions based on that alone, but I have to be willing to accept that those things are going to happen. So for this money that I'm holding in my hands that I'm going to put into this deal, am I okay if it takes a little bit longer, if the return is a little bit less? And that has to be part of the decision making.
Yeah, I think that's a good lens to view deals through, right? Can I live with the possibility that this does? And again, we don't want to go in assuming everything blows up and I just get nothing back. But because that would be silly, right? To our point, we wouldn't invest in anything if that was the expectation. But I do think that we should go in with realistic enough expectations to feel like, okay, we know. Here's what we don't want to do, and this is maybe the better point. Maybe not a better point, just another point to build on top of it, is we don't want to go in assuming that it's just a given that I'm going to be getting whatever the prospectus or whatever their suggested return is supposed to be, because that's when people that's when we feel like we've been jaded, even if we got a 10% return and it suggested an 18% return. Mm-hmm. Well, that just means that we're probably a little off in our alignment if we walk away too upset about that kind of a deal, right?
Yeah. Yep.
So I think it's a really good point that you make. Okay, you know what I did, Rod, when I was trying to figure out and kind of reevaluate how I evaluate deals? Any ideas? Any guesses, Rod? I'm not giving you much to go off of. So I'll just tell you. So anyone who listens knows that I've got another close friend, Jarvis. And I went into Jarvis.
I should have been able to come up with that.
I asked Jarvis. That's why I thought there was a possibility. I thought there is a possibility I'll come up with it. So I went in, talked to Jarvis, aka ChatGPT, and asked Jarvis to act as an investor who's being extra critical and trying to really vet deals and go through and give me all of the things that I should be considering. It's much broader, much bigger than this. And admittedly, I haven't gone into the depth that Jarvis suggested, but I have used that kind of a lens. I took out those key things that I felt like were really important. Actually, again, I had Jarvis do it. I was like, okay, Jarvis, that might be a little too far. Let's bring it into something that's a little bit more reasonable. But what's really cool is there were multiple questions, multiple thoughts I had not even considered.
Yeah.
And it made me think, goodness. Anyway, so a little bit of, I don't know if I'll call it advice, but if you're wondering where to start, like how do I come up with a set of guidelines, you can very easily go in and just say, hey, ChatGPT, this is who I am and this is the kind of stuff I invest in. I need a set of guidelines to make sure that I'm doing the best vetting of these deals I can possibly do. And ChatGPT will set you up quite nicely. So that's my advice.
That's the beautiful thing about the iterative process inside of AI is you don't just ask the upfront question. You don't ever just ask one question, right? You ask the upfront question, you get some answer back, and you dive deeper and you challenge certain aspects of it. Are you sure this is the case? Or, is there anything else? Or so that you can really be thorough in getting information out. I know that's what you do. You just probably take that for granted, but
man, I love doing it. But it really is an easy way to do that. Like I'm not pumping it up because I like make money or get there's no value in me pumping it. The only thing is it's just been an incredible resource. And the more I've learned how to use the resource, like the more powerful it becomes in a lot of different ways. So Rod, I want to announce something before we close up today. So we're a day before this, but if you're listening and you have not registered or if you haven't seen any emails for our new series, we're doing the Investment Insider series. And the goal of the series is really to bring in investment opportunities that we think are at least worthwhile for people to consider. Now, I want to be really clear about this. We're not doing the level of vetting that we're endorsing these deals. There are some of them that I'll let you know or will let you know if we're part of or have done. But the real goal is to say, and the reason we're doing it is because we get people every day asking us like, hey, where can I look for good opportunities? And we're fortunate to be around a lot of really great investors. So our goal is to bring great opportunities that, again, that we think are going to be worthwhile. And then we'll let you kind of take those things to the next level, do that additional level of due diligence. But don't miss it. It's happening. The first one is happening on Tuesday, the 24th. Is that the right date?
Yep.
So this will be out on the 23rd. If you're listening, make sure you go register. And thanks, everybody, for listening. We'll see you next week.
Thank you for listening to the Money Insights podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.